This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. The oil market is likely to be in balance in the second half of 2021, even though European coronavirus lockdowns and US winter storms caused disruptions in March. Crude and petroleum products market price structures showed. After sharp declines of oil inventories this year, the pace of destocking slowed in recent weeks, prompting OPEC and its allies, a group known as OPEC+, to lower its 2021 demand growth forecast by 300,000 barrels per day, BPD. The group now sees demand rising by 5.6 million barrels of oil per day. Brent's front-month spread is back in contango, a situation where the futures price of a commodity is higher than the spot price. This structure of the market encourages storage of oil.
Fruit and vegetable harvests are underway in Western Europe with seasonal workers gathering crops in top producer Spain. But costs are rising as farmers fear a third wave of COVID-19 might cause a repeat of 2020's damaging disruptions in labor supply. Harvests rely heavily on workers from Africa and Eastern Europe, but many couldn't travel a year ago as borders closed in the first wave of the pandemic. Shortages of key goods appeared in supermarkets while prices rose as consumers hoarded. Coronavirus cases are surging again in Europe, raising the risk of crop losses and adding to farmers' costs on everything from extra transport to keep workers socially distanced to buying protective gear for seasonal laborers.
Moving on to the top news in the energy sector.
OPEC Plus has lowered its 2021 oil demand growth forecast by 300,000 barrels per day, reflecting concerns about the market's recovery as new coronavirus lockdowns take hold, a move that could strengthen the case for a cautious output decision this week. The Joint Technical Committee, which advises the group of oil-producing nations that includes Saudi Arabia and Russia, met on Tuesday ahead of a ministerial meeting on Thursday to decide output policy. Despite the ongoing destocking of commercial OECD stocks, they remain above the 2015 to 2019 average, while recognizing that prevailing volatility in the market structure is a signal of fragile market conditions, according to the JTC report seen by Reuters.
China's Shanghai Futures Exchange said on Wednesday that its low-sulphur fuel oil futures contract had been used as a price benchmark for the first time in international trade. Freepoint Commodities Singapore Private Limited had signed the contracts with Chimbusco International Petroleum, Singapore, Private Limited, China Merchants Energy Trading, Singapore, Private Limited, and COFCO International Freight SA, the exchange said in a statement. It is the first time that China's fuel oil futures price is used as the pricing benchmark for overseas trade, said the exchange.
Next, we have the top news in metal markets.
Nickel prices may soon fall amid fast-rising supply from Indonesia, an official at Chinese stainless steel and nickel giant Tsingshan Holding Group said on Wednesday. Nickel prices have been supported by rising demand from the electric vehicle batteries sector, solid consumption from the stainless steel industry and supply chain disruption after top ore producer Indonesia banned nickel ore exports from 2020. Benchmark 3-month nickel in February jumped to its highest since May 2014 at $20,110 a ton, partly fueled by global stimulus programs to revive the global economies from the impacts of the coronavirus pandemic.
Copper prices rose on Wednesday on strong factory data in top metals consumer China and on hopes for an influx of new U.S. infrastructure spending. A stronger dollar and rising U.S. bond yields, however, curbed copper's gains. 3-month copper on the London Metal Exchange had gained 0.1% to $8,783 a ton by 1600 GMT. But it has lost 3.3% this month and is on track for the first monthly fall since March 2020. Today's focus is on Biden's infrastructure bill and the Chinese data is also quite positive, so that's providing some support, said Xiao Fu, head of commodity market strategy at Bank of China International in London. We will now look at the top news in the agricultural sector. Chicago soybean and corn futures surged by their daily trading limits on Wednesday after the U.S. Agriculture Department, USDA, released smaller than expected U.S. planting intentions. Wheat followed higher, despite USDA's higher than expected quarterly grain stocks. The most active soybean futures contract on the Chicago Board of Trade added 70 cents to $14.36 minus 3/4 per bushel by 12:44 p.m. Central Daylight Saving Time, 1844 GMT, its biggest daily gain since May 2016. CBOT corn gained 25 cents to $5.64 minus 1/4 per bushel, while CBOT wheat added 19 minus 3/4 cents to 6.21 minus 1/4 per bushel.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.